today, thank you for coming to the SPRI seminar series, and today we've got Muriel Watt to speak to us about Australian PV market update and grid parity implications. So Muriel is a part-time lecturer at SPRI, and she's been involved in setting up a number of the courses at SPRI, and so some of you might know her. It wasn't until I read her biography that I realised she does all these other things too. So she's also chair of the Australian PV Association, and she's head of energy policy and PV for renewable energy consulting company IT Power Australia, and she holds the positions of the Australian representative of the Executive Committee on the International Energy Agency PV Power Systems Program. Wow. She's a member of ASI Research Advisory Committee and of the Enterprise Connect Clean Technology Advisory Committee. So she's got a lot of experience in this area, and so rather than continue to talk, I'll hand it over to Muriel. Thank you.
Thank you. Thank you, Alison. And I must say that a lot of the update material that I'm going to present is from the most recent PV in Australia report, which is prepared by the Australian PV Association with funding from the ASI. Not all of it is from that, but most of the newest numbers are from that. So I want to talk just very, very briefly about the global market and drivers, and then look at the Australian market in more detail. And then I'll just look at what that means, what current prices are, and what that means for levelised cost of electricity from PV. And then talk about grid parity and what that might mean for future uptake. Then I want to look at the implications for the grid, and the grid as we know it, and the sorts of regulatory issues that are now starting to arise, largely because of what's happening with PV. So you're probably familiar with most of these numbers, but it gives you some background on how Australia compares with what's happening in the rest of the world. If you look at the markets internationally, 2009, 10, 11, you know, it's been growing very, very strongly, as you know. This year they had projected about 32 gigawatts, but I think everyone's going to up those predictions soon, because there's some quite rapid increases in markets like Japan and other places. So, you know, we may see it going above 32 gigawatts. So certainly by the end of last year we had more than 70 gigawatts installed. So PV is no longer just a tiny niche market activity. It's a serious player in the energy field and one of the fastest growing energy technologies. The holy grail of module production was to get to modules below $1 a watt, which we did last year. And now we're seeing prices, you know, as low as 60 cents being quoted, certainly 60 to 80 cents a watt. The market's driven on the grid side by international countries and the targets they've set and the policies that are in place. You know that Germany has been the largest market for quite a few years. It has met its target a long time ago, so its policy is now driven mostly as a sort of legacy of the feed-in tariff program that they've had in operation, and they're trying to ramp down, but the market is still very, very strong in Germany. So they haven't got a specific target in place, but other countries have, and the targets vary between, you know, having certain gigawatt capacity, sometimes a percentage of electricity, and so on. So you can see, you know, most countries quite strong targets, and these are being revised, usually upwards, quite often, because the market's growing more strongly than people had predicted. So then looking at Australia, that's a nice photo of one of the few commercial PV systems in Australia. If you've been to Alice Springs and had a chance to look at that, it's quite a nice system, 300 kilowatts. So last year we more than doubled from the year before, so we had a really dramatic growth in the Australian market. The red line is the grid connected, the small scale, typically residential grid connected market. we had a very strong off-grid market for many years, and we still do, but it's sort of dwarfed now. You can't really see it very well in this slide because the grid applications are now dominating the market so much. But you can see why interest in PV, from everyone, including the network operators, is really quite strong now, because this sort of uptake was well and truly in the top 10 in the world, and so the actual annual installations are shown there, and really from the 2008, certainly by 2009, all of that growth was due to the if you remember, we had a PV rebate program which doubled from $4 a watt subsidy to $8 a watt subsidy, and that really kick-started the market very strongly. And then we've had various feed-in tariffs in play. We've had the solar multipliers in the renewable energy target mechanism taking over from direct rebates and so on. So the market in the small scale has been pushed very strongly. This year, we're sort of seeing the end of most of the feed-in tariffs. Queensland was one of the few states that still had a feed-in tariff. They cancelled that on Monday. We're going to have the carbon price coming in from next week. We're going to have the solar credit multiplier. I'm not sure if you're all familiar with the solar credits. Does anyone need an explanation of solar credits? You do? Okay. The renewable energy target in Australia, which is nominally to reach 20% renewable electricity by 2020, and it has a number of parts to it. But that target is driven by a mechanism called renewable energy certificates, and you get a renewable energy certificate for each megawatt hour of electricity produced from a renewable energy source. For small scale applications, for instance, PV systems on residential rooftops, so anything for PV, anything below 100 kilowatts, you can opt to deem your generation forward and claim renewable energy certificates up front for the first 15 years of what you deem will be produced. And there's a formula that you can use to deem your certificates. And you can, those certificates are now called solar credits, but they're the same mechanism. And they have been, for systems up to 1.5 kilowatts, you have been able to get more than one renewable energy certificate per megawatt hour of electricity for the last few years. It was 5 times, and then it went to 3 times, and from next week it'll go to 2 times. So that's been a very strong driver for small-scale renewables in the renewable energy scheme, but by and large they're hoping to get most of the renewable energy target met by large central generation technologies. We've had the first of the PV flagships announced. That will be a First Solar flagship, 156 megawatts. And the price that the winning bid that was quoted at $2.80 per watt installed. So we shall see that flagship starting to be developed between now and I think they've expected to be operational by 2015. The commercial sector hasn't been driven nearly as strongly as the small-scale residential. It, of course, can generate renewable energy credits, but it doesn't get as much benefit from the multiplier, the solar credit multiplier, because typically you'll want systems much bigger than 1.5 kilowatts, which is the limit for your multiplier operating. So that sector has struggled, and in fact now, even though it can be cost effective for many commercial applications, it's much harder to access the commercial market. We've seen systems take a year to get installation approvals and then be charged, $100,000 for a 30 kilowatt system to connect to the grid. There are huge barriers to the commercial market. It's not straightforward. There are no standardized connection agreements like they are for residential. So that's the area that really needs work in the coming year. Some of you will recall that we worked very hard to get the standardised procedures in place for the residential systems about 10 years ago. We now have the next lot to work on. So this is one of the reasons why the market really took off in the last few years. So we had a lot of those mechanisms, those drivers in place from government, feed-in tariffs and solar credits and so on, and at the same time the prices that people were seeing in Australia were just plummeting. This was driven by falls in the price internationally, as well as the Australian dollar exchange rate changing quite dramatically from something like 55 cents to $1.10 against the US dollar over that time period. And as the market developed really rapidly, installers streamlined their installation processes quite significantly as well, so that you see the system cost also fell quite rapidly. So at the beginning of this big drop, we were having installers doing, say, one system every 2 days. By now they're doing 3 systems a day. So that really streamlined that delivery side of it, and that has brought the whole system cost down a lot as well, after having been quite stable for many years. The employment is harder to judge because there's a lot of different people in the game, and it's with the market developing so rapidly, it's been very hard to keep track of the employment at the installer end particularly. But there are something like 5,000 registered installers in Australia, and many of those employ other people who are not accredited, but to help with installation. So you can have that number, the green number is the installations. But if you look at the top number, that I thought that was interesting for this year, because there's a whole lot of interest at that higher level now of financial services, legal services, market analysts, consultants, renewable energy credit traders, certificate traders, education and training, a whole lot of new jobs being created in that space, which just weren't there. There isn't an investment bank in Australia now that doesn't have someone allocated to PV. So it's quite interesting. All that sort of side is moving quite rapidly. Just thought you might be interested in where the R&D money is going. Until this year, it was very, very dominated by the red part of that, which was the market support, because we had the Solar Homes and Communities Plan providing lots and lots of money as direct subsidy, but that's gone now, and so we have a pretty even spread of research and development funding from pure research through demonstration through to market support. This is only government funding, but it is state and federal. And the state governments actually provide quite a bit of this. So I want to now mostly focus on what all that means for the cost of electricity from PV systems, because that's probably the driver from now on. Until now we've sort of been worrying about the capital cost of PV systems, but from now on we're going to be much more interested in the cost of electricity from PV systems and where that's going. So the of grid parity is when the levelized cost of PV electricity, so if you take the capital cost and amortize that with all the parameters that you need to, interest rates and depreciation and so on, if you do that over a 20-year, say, life of a PV system, you get, and you see how much electricity you're going to produce, and of course that depends on where you install that PV system, you get a levelized cost of electricity. And that's the only way you can compare that with the electricity that people are buying from their retailers, because that's based on a cents per kilowatt hour. So to be able to do that same comparison, you've got to be able to do this for PV, because telling people that it's going to cost you $2,000 is one thing, but they're going to say to you, well, how does that compare with the electricity that I'm buying? So you need to have some way of comparing that. And while having said that, not everyone makes decisions, particularly the residential sector level, to buy PV based on the levelised cost of electricity. They're much more driven by affordability issues. And when PV systems cost $20,000, the market was very limited. But with PV systems now available for $2,000 or less, it's very affordable for people. And so the decision making can be quite different. Nevertheless, from an economic point of view, you need to use the parameters that give you the full levelised cost, and you can compare then across technologies. And our analysis shows that now almost everywhere in Australia we have reached grid parity for residential customers. So that is why I'm saying we probably need to stop thinking about dollars per watt and start to think about cents per kilowatt hour, and be promoting PV in a very different way. The solar credits and the feed-in tariffs and so on remain useful because they either help with the capital cost initially or give you this cash flow, but they're also giving people a sense of confidence that the government supports this technology, that it's a good technology to go with. And in countries like Japan, in their previous program, they ramped their support down gradually till they were only providing 10% of the initial cost, and the market remained strong. But the minute they removed that last 10%, the market crashed. So it wasn't the amount of support they were getting, it was the what they perceived that support to be giving them, and that was the government sort of feeling that this was the right thing that they should do. So if all, we will have the solar credits going down, but there will still be solar credits there till 2020. So I think that will still play an important role, even if all the other things fall off, and even if from a cost point of view you don't necessarily need it. The market's certainly spooked every time there's a major change in any of the support mechanisms. So when the feed-in tariffs change, like they did last year in New South Wales, the market just plummeted here. It is gradually picking up now, but Queensland, despite the best advice about how not to do a policy, they've done exactly the same thing as New South Wales did, and we will expect to have a really big boom of installation applications in the next 10 days before they change their feed-in tariff from 44 cents to 8 cents. And then we will see their market crash in a heap after that. There's a lot of negative media. The more visible PV becomes, the more the market grows, the more we're going to be right in the sights of people who see us as a threat. And so, get used to it. We're going to have a lot of negative media about everything to do with PV. You're going to get electrocuted in a flood, you're going to have it blow off in a cyclone, it's going to do something really bad in a fire, etc., etc. You just wait, it'll all start to come. And so we need to be prepared. We need to have our facts ready for all of those sorts of things. Customers sometimes, even though we do a levelised cost of electricity over, say, a 20-year life, customers don't necessarily make decisions on 20-year time horizons. The average turnover in homes in Australia-wide really is between 7 and 10 years. So often people will say, well, if we probably won't be in this house for 20 years, so does it make sense to put in something that hasn't paid for itself before I have to sell? So those sorts of decisions mean that the way customers make decisions is different to what the levelised cost of electricity will tell you. We've certainly had a lot of bankruptcies and companies collapsing in the last year after the New South Wales market collapsed, and we're likely to see that in Queensland from next month. And this is happening also on a world scale as the PV industry sort of consolidates and a lot of things will change. It's a very new industry. It's grown very fast, and there's likely to be a lot of change before anything settles down for a while yet. But it does mean that we're entering a new era now where different types of marketing strategies are probably going to be useful. And so one of the new ways of selling PV that you might have already seen are companies that are selling you a 20-year electricity contract from a PV rather than selling you a PV system. And they're guaranteeing you a cost of electricity from a PV system that's lower than your retail tariff from your standard retailer. So that's the sort of new marketing. In fact, the company that's selling that is one of our ex-students, so, who went and did that in California, Andrew Birch. I don't know if you remember Andrew. Anyway, he did that in California and was very, very successful, and now he's coming back and setting that up in, and I think in California now 40% of the sales are on that type of model where you're buying the electricity over a long-term contract rather than buying the PV system. So we're likely to see that change in marketing strategy coming to Australia. So this is what it looks like if you, if the blue line there is, and there's a lot of assumptions built into these models, and if you want to know the details, ask Graham, who's sitting over there, because he actually developed these models. These are models that the Australian PV Association developed with some funding from the Australian Solar Institute. They've been modified a lot since the initial work that went into them, but we still use them a lot and keep updating them. So if, depending on the assumptions you make, this is about the cost of electricity from a typical residential grid connected system now, and our projections based on trends for efficiency and cost and so on of what that cost will be over time. And these dotted lines are the cost of electricity that you're buying from the grid. So it's grid parity is when these lines meet. Now you'll see that we've got a very wide error bar around that blue line. There's a lot of things that can be different. You can have the exchange rate, you know, go back to 55 cents. You can have a whole lot of things happen that will change that levelized cost of electricity. But we're actually seeing prices more at this end of that error bar now. So we're below what we would have said was the standardized price trend, and you can see why now companies can offer you a 20-year power contract from a PV system lower than the tariff that you're being offered. The two lines here, the red and the black one includes the carbon price. So, you know, if Tony Abbott gets in next year and we don't have a carbon price, we still reach grid parity because the red line is the red dotted line. The hashed lines at the top are the net present value of that grid electricity. So in other words, really what you're buying when you're putting a PV system in here is electricity for 20 years. You're buying it forward, and so you're not actually displacing the price of electricity that you're paying now. You're displacing the price of the electricity now and what it will be for 20 years hence. And so that is assuming this growth is a higher actual price than what you're paying today. So if you take the net present value of all the electricity that you're going to displace with your PV system, if you put one in now, that's the value of that electricity, not that. And so certainly if you look at the net present value of electricity, we've more than reached grid parity. I said there were lots of things that can change to make that, that line different, and these are the sorts of sensitivities. The power of the dollar, the purchasing power of the Australian dollar compared to the US dollar, for instance, module efficiencies, the margin that the installer chooses to put in, whether you've got a distributor in the system or not, or whether your installer is buying modules straight from the factory. We had a whole system set up with a distributorship sort of model until, say, 2 years ago, and now very little of the PV that comes into Australia comes via a distributor. It comes directly. Inverter costs can vary, module costs, interest rates, a huge influence on the levelized cost, because you have to assume the customer has a background interest rate that would be effective, particularly if they're putting it on their mortgage, or otherwise would use that money to do something else. In the commercial sector, grid parity is also close and may well be there depending on where you sit on this. And the issue with commercial tariffs is that the published tariffs that we've got here in the dotted lines are not necessarily what particularly large commercial customers will pay, because for a typical large commercial customer, they'll get an energy price and a demand price. They won't get a composite 22 cents the way we do for a residential. And the energy price may well be quite low, maybe 10 to 15 cents a kilowatt hour. So if you're buying electricity at that kind of rate, then obviously you need a much lower levelized cost of electricity from the PV system to be cost effective. But if this hashed line down the bottom is what the levelized cost of electricity would be if you had, if you rolled in your solar credits. So the solar credit is buying you, about 6 cents on your at the moment on your cost in this instance. So obviously it makes a difference, and the net present value, of course, is there if people want to look at it from that point of view. But as I said to you, the other complicating factor with commercial systems is that the cost of installation may not be driven so much by the dollars per watt of the PV, by what the electricity utility wants to charge you to connect that system to the grid. And that can be totally non-transparent and totally outrageous, depending on whether they want to encourage you or want to discourage you. Mostly at the moment they want to discourage you. The STC price, the solar certificate solar credit price, can vary quite a bit at the moment. Well, actually it was trading about $24 before the Queensland government announcement on Monday. I haven't actually looked. Has anyone looked since then to see what's happened? I would imagine that it's going to drop dramatically, because you can imagine that the Queensland market's going to absolutely go berserk in the next 10 days. So we might see that price drop. At the utility scale, this is larger systems that connect to the transmission network and not to the distribution network. So they're competing then not with a retail tariff, but with the bulk supply electricity cost. And so, they're competing directly with coal-fired power stations by and large. Sometimes with gas peaking plant, which has a higher levelized cost. But this is these lines here are the National Electricity Market, the NEM price projections that they themselves have made with and without a carbon price. So you can see the carbon price makes a big difference at this kind of level of generation, and the standard cost of electricity from a PV system, and this at the moment is sitting, a bit. I think the projections were between $2.50 and $3 a watt. installed for a large system. Now the flagship came in at $2.80, so you can see that that's the kind of cost you're starting with, and this is the cost with the renewable energy certificates that are available to that power plant. So again, the renewable energy certificates make a big difference. The carbon price makes a big difference at this kind of level. And you can see that if you had both of those in place, which we do at the moment, so if they both stay in place, then you can see that we're reaching grid parity by about, I don't know, 2018, something like that. But otherwise, we're not reaching grid parity. In other words, at that large scale, PV is still not going to be cost effective without those subsidies in place, whereas at the retail level, it definitely is for most markets. And that's because we've got the cost of distribution, which is the major cost in between those two things, in between these standard generation costs and what the retail market offers you. So we need, the more R&D, more cost reductions, a whole set of things. The other thing that we need, we have not built big power plants from PV in Australia, so we don't have a chain. We don't have an installation chain in place. And that's the way you can really get your streamlined installation and so on, and get your costs down. So at this stage, anything we build larger than sort of about 10 kilowatts is a one-off, and so the costs are higher than they would be if we had a pipeline of projects that people could sort of amortize initial costs across. There may be this intermediate market up to 30 megawatts. At 30 megawatts, you've got to apply to the Australian Energy Market Operator for your license to buy and sell into the market, and below that, you can operate as an unscheduled generator and come in when you have power and not worry the rest of the time. But so that's why below that there might be some opportunities, and it may be possible that you can put in a plant of up to 30 megawatts at a place on the grid where it makes sense to do it, where you would actually provide grid support if you were to do that. So there may be some opportunities, but at the moment there's no real strong drivers for that, and there's a lot of obstacles in your way because there's no streamlined process. So these are not predictions, they're just projections. Until Monday, I had the 2012 amount going below the 2011 installation rate, because we had about 840 megawatts installed last year, and we were sort of thinking maybe 650 this year, but the Queensland government's just sort of put this 10-day period in place where people can get the higher feed-in tariff before it crashes. So we can expect a huge boom. In New South Wales, when the government did that, we got something like 300 megawatts approved in that short window of time. I would imagine we'll get at least 300, if not 600 megawatts approved in Queensland in the next 10 days. That's going to just take that whole thing, off the scale, and we're probably going to be over a gigawatt installed this year as a result. So we'll see, but that does mean that you crash again next year, of course. I've just assumed that past all of these feed-in tariff ups and downs and booms and busts, the market will stabilise, and here I've used a 650 megawatt sort of stabilisation at the residential sector, and then have the other sectors keep growing a little bit at 15%. Now 15% was the growth rate we had in the market before we had all these extraordinary government programs supporting it, so I've just gone back to that as maybe some kind of underlying baseline, but who knows. It's a very different PV sector to what it was before we had all this market development. If you do that and you add the flagships in there, you get about 8 gigawatts installed by 2020. You can compare this, if you like, with the federal government projections of 2 gigawatts by 2030. And we're going to have 2 gigawatts by the end of this year, I would think, pretty close. So they're way behind in their thinking about what they think PV can do in this country. The Australian Energy Market Operator has started for the first time to actually take PV seriously as well. And it just put out a report that you might have seen a couple of weeks ago, where it was saying, well, like, you could get 12 to 18 gigawatts in the residential sector by 2031. So, and they're now starting to look at it and how it's impacting the electricity market. So there's enough PV out there to be making a serious impact on the electricity market now. So what does that mean for the grid? We're probably one of the first countries to reach grid parity, and that's happened because of the PV price, but because also we've had these extraordinary growth rates in the electricity prices, much higher than if we had done our PV projections a few years ago and said electricity prices would go up at 20% a year. Everyone would have laughed us out of court, because we had to use the really conservative 2% a year in all our projections that we did before. And of course, they've been growing at 10 and 20% a year. So we've had two things coming, the PV price is going down, the grid price is going up much faster than we had expected. So, those of us who did these sorts of projections a few years ago, we had expected grid parity about 2014, I think, in those early charts that we did, and we've come in sort of 2 to 3 years earlier than that. And so it's happened, we haven't got an electricity market that's geared up for that. We have a national electricity market that is based on having central power generation distributed to customers and sold at a retail level. There is no market at the end customer end of the market to provide any value to sell electricity back inherently. There's no right to sell back. There's no right to connect. There's no there's no market for selling demand reduction or energy efficiency or storage or anything. There isn't a market. There is not a retail market that is available for distributed energy at all. And so we've got the central electricity market operating, all this distributed energy now coming in, and no market operating in place. And so we've had these artificial markets created by the feed-in tariff programs, which has allowed you to connect and allowed you to put PV in, and now those are all stopping, and we're getting to the stage where electricity utilities are starting to curtail PV installations in some parts of the grid, and certainly being brought kicking and screaming to be able to pay you anything at all for the electricity that you sell, that you put back into the grid. And they've typically in New South Wales defaulted to the price of zero, and sometimes have offered you 6 cents or 8 cents a kilowatt hour. And IPART, the regulator in New South Wales, has said we run a competitive market, and therefore we don't need to mandate that they pay anything, that the competitive market will operate and retailers will pay us what it's worth. So as I said, they've decided on zero as what the competitive market takes you to at the moment, until there's some real reason why they have to offer you more. Having that kind of system in place means that there's going to be, once the feed-in tariffs are removed, there's going to be no incentive to export to the grid at all. And so people are going to try and limit the size of their system to what they can use when it's generating. That doesn't necessarily get you the most cost-effective PV, but that's what the market would drive you to. It will also drive you to put in storage, because weather storage is, people are not making decisions always on the cents per kilowatt hour. They're making it on, what makes sense for them. And they really, really don't like giving free electricity to AGL. And so there's a huge interest in storage. I don't know if those of you who went to the OSIS conference at the end of last year, there were 7 companies selling grid storage packages. Now that's unbelievable. I've never seen that before. We've had storage for off-grid. So there's huge interest in this. And I think when we see electric vehicle rollouts starting to happen, we've been waiting for that for some time, but maybe it'll start to happen, and then you've got that inherent storage as well. So there's going to be a lot happening with storage, and that will make quite a bit of difference. Now, you could say that really the grid operators should be looking at storage themselves at the grid level. If we're having all of this intermittent generation starting to come on stream. And at this stage there's only just a very few minor trials happening, so they're not really jumping at that opportunity as you might think that they should. There's also quite a lot of discussion about moving off the grid for people who are on the grid already. Now, if the most immediate response to the distributors in particular of having people have their own PV and therefore reduce what they're buying from the grid is to say, well, we'll put the network part of your bill even though you see a cents per kilowatt hour is made up with the costs from the network and the costs of energy and the retail costs and other things. But they're saying, well, we'll just keep putting the fixed price of the electricity up, and so your energy price will become a smaller portion of your bill. If you recall, we used to have water done that way some time ago, where you paid an amount for water based on your rates, regardless of how much you used. So what they're suggesting is we go to an electricity model. Now that had terrible consequences, if you recall, and no incentive to be efficient with water use at all. So they're proposing the same thing with electricity, that we go to this fixed charge with very little of the charge associated with how much you use. And that will mean that you could be having the same bill. You can put your PV in, you can do your energy efficiency thing, you can reduce your usage from 20 kilowatt hours a day to 2 kilowatt hours a day, but your electricity bill is going to stay the same. Now, a lot of people are going to be upset with that and not want to pay $800 a quarter when they're using 2 kilowatt hours a day. And that's where the interest in just chopping that line might come in. And we've done it with our phones, and we had this discussion the other day that, well, it's different with phones because you've still got the invisible network for a mobile phone that you haven't got with, that the analogy is not quite the same. But we're getting our electricity from the sun. So, we have got a source of energy, even though it's not coming through a line. So, we'll see. There was a very interesting report put out by the ATA 2 days ago, where they actually did the costs of people disconnecting from the grid rather than undergrounding their power lines, which they're now doing in bushfire areas in Victoria. And of course it makes so much more sense to go off the grid than to pay $90,000 to underground a power line in those sorts of installations. So I think we'll see that happening by default in some of those locations, and then the technology and options will become available to everyone once you start doing it. And this is really what I'm talking about the cost of the network being such a huge portion. This is the increases that we're seeing in electricity at the moment, and this is where most of the increase is coming from. So if you see all the reports about why the solar programs are driving the cost of electricity, they're lying when you see that kind of number. Despite being one of the first countries to reach grid parity, we're actually the least able to absorb a large amount of intermittent distributed generation of all. I mean, even the US has such a wide mix of power supply in its generation mix. It's got a lot more gas, a lot more hydro. It's got a wide range of sources coming in. We're just pretty much predominantly coal. And so our grid is designed around that very inflexible type of power generation unit where you can't easily turn things on and off with a coal-fired power station. And so we've designed our grid for that. You know, we've attracted aluminium smelters and all of those types of industries to provide that baseload power need. We've had off-peak water heaters. We've had a whole range of things that were specifically in place because we had coal-fired power station. Now, baseload in itself is not an inherent, you know, a natural phenomenon. It's there because we happen to have a coal-based grid, and we needed to keep the generation, the demand as flat as we could. So we've created what we are now calling baseload, and as a result of that, we've got a grid designed for that. So when we suddenly start to add all these little generators all over the place on the distribution feeders, they're not necessarily designed or able to cope with that. And they're not smart grids. They're grids that were built in the 60s or something. They haven't got the communications. They're very worried about reverse power flow through their substations. They can't see what's happening with people's PV. They can't control it. They're very concerned with huge fluctuating power sources coming on their networks. And so we're seeing that becoming a really big issue. And because our grids are regulated to the point where, you know, if we have a 5-minute blackout, the CEO loses their we've just sort of got that mentality that we have to have a super strong grid. It's never got to fail. You know, you've got to have a really good reason if you have a blackout in Australia. Other countries are not nearly so thingy about their grids as you might have experienced. And so we're spending a lot of time and money upgrading these grids, and we're upgrading them because, you know, they're 50 years old, and because demand has per capita demand has increased in the past. We've got air conditioning going in and so on. But we're not taking into account, when we're spending this sort of $50 to $70 billion over the next 5-10 years, we're not taking into account the fact that the demand pattern is going to be very, very different. PV, you know, you're not going to stop PV now. And the implications on the grid are quite, are going to mean that they have to rethink what they spend that $50 billion on. But that discussion is not happening. They're not being asked to justify their expenditure on the grid and whether they are building us a 21st century grid or just rebuilding a 19th century grid. And those are the sorts of discussions that we probably really should be having now. Otherwise we'll end up with a stranded asset, and we have to pay for that stranded asset because, you know, the networks are still owned by us by and large, and we're going to have this $50 billion that we spend in the next 5 years, and we're going to be paying for it whether we're using it or not, one way or the other. And so it's a pretty serious question. You see a lot of debate about the similar expenditure on the national broadband network, but no one's questioning this expenditure and saying, could we do it differently? Or are they doing the right thing with that $50 billion? So really where we've got to start is with the regulatory arrangements that are in place now, which are no longer appropriate for the future as we see it. We have the retailers earning money by selling kilowatt hours. We have distributors earning money by kilowatt hours flowing through their networks. We have the generators earning money by selling kilowatt hours. There is no incentive there at all not to keep increasing the kilowatt hours going through that whole system. And so there isn't an inherent way of putting into that existing framework some value for distributed energy, some value for reducing demand so that we don't have the peaks that we now have for, 3 hours a year that we're spending 20 out of the 50 billion on to try and cope with. We don't have any incentive for energy efficiency. We don't have any incentive for putting storage, which might ameliorate some of the issues that they're facing. Any of those things, as I said before, just don't exist. There isn't a market for that. And we've got the discussion. The only discussion is, oh, we'll put time of use meters, as if this smart meter, so-called, will fix all of this stuff. Well, it won't fix it. It's just a meter that can, give you a readout by time of use. It's not inherently smart. The smartness is what you choose to do with it, and none of that discussion is yet happening. So we see now that as a result of electricity prices going through the roof, as a result of a lot of PV going in, and energy efficiency measures like, the pink bats, a really effective thing to do, despite the politics around it. So we're seeing the impact of all of those measures, and electricity use in Australia has actually started to go down, the residential sector in particular, for the first time ever. And all the people who've been doing the projections are just flummoxed. They really don't know how to cope with it. And so if you look at ABARE, all their charts have this increase, and those are still there. And the fact that it's actually gone this way, they're going, oh, that's just a glitch. It was a cool summer. And, they really, really don't know how to deal with something that is they have always assumed would keep increasing to have that go down. And if we have a whole system based on selling kilowatt hours, and those kilowatt hours start to go down, how does the system operate? How do we have retailers operating as their demand keeps going down, the distributors operate? That just means they'll have to put their prices up, and that of course has exactly the impact that they don't want, because the higher the prices go, the less people will use, and the more they will go to energy efficiency and other things. So it's going to be a very vicious cycle going on, and we need to find some way of using our assets better, of putting in place an energy system, an energy market in Australia that's going to work in the future. So I think I've sort of already... One of the interesting things about the price elasticity of electricity, any paper that you've ever read has said, the elasticity of demand for electricity is very low, 10%. You put the price up, you only get a tiny movement in what people will use. Well, that has just been proven wrong. And it's been proven, I suppose, wrong possibly for two reasons. One, at some price point, people actually do things that they wouldn't do before when electricity was perceived as cheap. So people's electricity bills in New South Wales have virtually doubled in the last 2 years. That's resulted in some action. The other thing that's happened is people now have a choice. They didn't have a choice before. Now you can put in PV and get cheaper electricity. So that means the elasticity equations are quite different to what they were. There's a whole lot of things people can do that they didn't have available to them before, and so they're going to have to totally rethink the whole theory on elasticity of demand for electricity. So hopefully the economists are working on that now. So if we had a distributed energy market, what are the characteristics? I mean, we don't know. We haven't done one of these before, and it took us 10 years to get the national electricity market rules agreed and in place. So it's going to take us a while. And in fact, these things are happening now. So we're going to have a lot of chaos in between, what we're seeing now happening and getting any kind of decent market in place. So we need to start to think about it as soon as possible and put ideas into the policymakers and the regulators' minds about what they can do about this stuff. You need to be, at our end of it, we need to get value for PV electricity that goes back into the grid. We need to get value if we opt to turn off our air conditioners when there is a peak that the network is finding difficult to cope with. We need to get value if we use our inverters to help support their frequency or their voltage. We need to get value if we decide to put in storage to help the grid manage its supply demand as we get more intermittent generation in the mix. None of those things exist, so how do we create that market for customers and have a very different energy service model of energy delivery in Australia? We have to be able to know how we value the network being there and how much network we need. We might not be using the network in the same way that we've used it in the past. We may end up with sort of mini grids operating within a region with only skinny connections to a central transmission line or something, and that within that little region you might be pretty self-sufficient most of the time. There's a whole lot of mixes of what could be done at an individual household level and at a sort of suburban level or a village level. And then what happens at a larger scale. So we need to sort of think about what those options might look like and put incentives in place to get the option that's best for us, that drives the decision making around that and work out how you're going to trade these things, who's going to trade them, how you define the value, all of those things. So that's, I guess, where I'd like the discussion. I'd like you to kind of tell me all your ideas, come up with what you think should be in this market, because really this is the game now. This is PV. It's not just for PV that we need this market, but PV needs it to be in place, but it will assist then with energy efficiency, demand management, storage, all the other things will benefit from having this kind of market in place. That's all I wanted to say.
So thank you very much, Muriel, for coming in. And,